Canadian energy stocks are still sinking today on concerns about what the Venezuela incursion means for the Canadian oil industry. Let's go to Teal Linde on this, manager at Linde Equity Fund. Teal, thanks for joining us. We heard the Prime Minister saying today that Canada's oil does remain competitive. Do you see Venezuelan product as a threat to Canada's industry?
No, I believe that the fears are overblown. And if we just, the late Charlie Munger had a famous quote that he said where, show me the incentive and I'll show you the outcome. And so along these lines, I think President Trump will be ultimately left disappointed with the oil and gas industry not living up to what he expects of them. I don't think he appreciates just how much the corporate strategy has changed in the oil and gas sector over the last 10 years. I mean, it used to be all about production growth for most of his life. And yet in 2014, when the oil price collapsed, the only way that the oil and gas industry can get sort of new investment from Wall Street was to abide by Wall Street's new demand that the industry now sort of prioritize maximizing cash flow and profits to accelerate shareholder returns in the form of share buybacks and dividends, and heading off to Venezuela runs counter to those objectives, which are basically embedded in the compensation packages of the board of directors and senior executives of these oil and gas companies.
Okay, so basically the business model has changed, and you don't think that Venezuela supports that. But Washington is floating the idea of supporting the oil companies that go into Venezuela to rebuild infrastructure. Do you think that is enough to lure them back?
No, well, I mean, the White House is saying that if they want to, it's basically saying if you want to get refunded or repatriate what was taken from you, then you have to go on and invest. But I've seen the numbers. I mean, ConocoPhillips is the one that lost the most. They had about $10 to $12 billion of assets that were sort of nationalized and taken from them. And then Exxon had $2 billion. And then after that, it runs pretty small. And so when you look at the numbers that it's going to be required to increase production from 1 million to 2 million, you're looking at tens of billions of dollars. So I can't see why these companies are going to rush in there to have to spend tens of billions of dollars when in return for $2 billion or $1 billion to repatriate what was taken from them a couple of decades ago. The ConocoPhillips may be in a different situation because they did lose the most.
Okay, let's get to some other markets, some other storylines. We had another record close for the TSX yesterday. We're headed that way again today. What is your forecast for the TSX this year?
Well, the TSX, I mean, last year, it really had a lift from the materials sector. And 75% of the material sector is represented by gold stocks. And if you look at the breakouts or the surges of the price of gold over the last number of decades, it's really shot up beyond where it historically has done in the past. And so I think that the run in the material sector is probably largely done. The financial sector was also up about 30%. And so you had a lot of sectors sort of lift largely last year. And I just think that there's probably due for a breather. So I think the TSX, which really outperformed the U.S. market at its strongest level in a couple decades, is probably due for a breather.
Okay. Are there other wider reasons to be cautious this year?
Oh, yeah. There's no shortage of reasons to be cautious. You've got, I mean, market history. If you look at the U.S. market, it's a U.S. midterm election year, and those years have been noticeably underperforming the other years. I mean, since 1950, the U.S. midterm election year, the average return has been 3.8%, compared to about 11% for the other years. You've got valuation risk. The U.S. market, the S&P 500 is trading around 22.5 times this year's expected earnings, which is based upon 13% earnings growth this year. And so you're really sort of priced for perfection, and there isn't much error for error. The margin for error is slim, and so any kind of disappointment could easily compress the market multiple and create a sell-off. You've got AI perhaps being a double-edged sword. I mean, AI has been responsible for a lot of capital investment, GDP growth, and stock market optimism. But if AI truly lives up to its potential of replicating the human mind, then massive job displacement will inevitably start to occur. And if that happens in a consumer-based economy, that's probably going to dampen enthusiasm for the stock market. And then finally, you've got policy risks. I mean, inflation is still running over 2%, sometimes close to 3%. You've got a Federal Reserve that's being pressured by the president to lower interest rates. He's going to be able to choose his own Federal Reserve chairman. which was expected to adhere to his desire to lower interest rates. President Trump even said that he expects the new Fed chair to consult with him on interest rate decision policy. And so lower rates, and so the risk is you can have a run it hot scenario where the Federal Reserve is lowering interest rates while inflation is still high, and you could have backlash from the bond market, which could push up long-term yields, which will certainly put pressure on the stock market. So those are just four risks.
That being said, is it a bull year or a year for the bears?
Well, I mean, there are reasons for it to be bullish as well. I mean, you've got market history again. Whenever you're in the fourth year of a bull market like we are right now, there have been 7 instances since 1950. The average return has been 12.8%. You've got interest rates coming down. I mean, that is a positive, but it's probably more of a short-term positive. You've got fiscal policy. You've got the Big Beautiful Bill Act, where they have front-loaded the tax cuts, front-loaded increasing, which was going to cause an increase in discretionary spending, and they're pushing back into later years the government spending cuts. So that inevitably is going to have an increase in consumer spending and corporate profitability. And then finally, you have deregulation. The Trump administration, in one of its executive orders in January, was called the 10-to-1, which meant that for every new regulation that was imposed, 10 older regulations had to be repealed. And they've also frozen regulations for compliance, which is expected to save billions of dollars in costs for consumers and companies. And so, I mean, so there's a number of reasons. Now, if we have to decide which side is most likely to prevail, I think if you look at the trifecta of monetary, fiscal, and regulatory forces that are in play, usually you see that being applied during a recession and to help revive the economy. And so you're having those three forces aligning right now. And so it's really sort of adding fuel to the fire. So at least in the short term, that's going to be supportive of the economy and therefore the stock market. So at least for the current year, 2026, we're in that tips us into the positive camp.
All right. I do want to get to one or two of your stock picks. The first one you like is Intact Financial. What do you like about Intact?
I think, well, with these top picks, these are ones that I would consider to be long-term, not to look back in 12 months, but sort of buy and hold for forever stocks. Intact is simply a more consistent and stabler financial company than, let's say, the Canadian banks. 10% earnings per share growth over the long term, and room for acquisition still within Canada. Property and casualty insurance is what Buffett's invested the most in over his career, and PNC and Intact, I think, would fit the bill for what he would identify as a high-quality PNC insurer.
Okay, quickly, because I'm running out of time, I do want to get to your next pick, which is Uber. Do you see some growth for Uber? If so, where?
Well, Uber, it's more this time I would call it like a Peter Lynch type pick. I mean, if you look around at the companies and the providers that you pay money to, I mean, it's pretty incredible how much people use Uber. There's not much selection and choice, and they're still growing their monthly users by about 15 to 20%. They're expanding around the world. They've got partnerships with 20 different autonomous vehicle makers. So they expect to be a player in the autonomous, sort of the self-driving taxi market. And it's trading around 24 times your expected earnings. So you're getting you're paying a near market multiple for a company that's growing much faster than the market.
All right, Teal, I got to leave it there. Thanks for joining us on The Close. We'll talk to you soon.
Thanks for having me.